So there are several pillars to why we remain constructive about risk assets, or more specifically, U.S. stocks and equity allocations heading into 2026. Well-behaved treasury yields, an accommodative Fed, or at least a Fed that's not hiking anymore, a Fed that's more likely to cut probably over the next 6 to 12 months than hike. A stimulative fiscal policy mix with the One Big Beautiful Bill Act coming online here in the first quarter and first half of 2026. And last but not least, expectations for and pretty strong signals that corporate earnings growth in the United States is likely going to come in at a clip at 10% plus in 2025, and we see a similar setup in 2026. So, what are the drivers of this? I mean, that at first of all, we've probably got above trend GDP growth, so this is going to help the top line for companies. And when I say above trend, I mean maybe 2.5, 3%. Interestingly, the Atlanta Fed GDP now forecast is suggesting the economies had grown at a 5% clip in the fourth quarter. We'll see if that pans out. So you've got, just a pretty decent GDP growth backdrop helping revenue. And then we've got companies becoming more efficient. It's a double-edged sword. I mean, they're not hiring, so that's not great for payroll growth, but it is good for corporate profit. So it's sort of a Goldilocks scenario where there's not like they're not really hiring, but they're also not firing. So the low hiring, low firing environment. And then you mix in some AI-driven productivity and efficiency enhancements. And this is sort of an elixir that can drive, we think, 10, 12, 15% earnings growth over the next, through the end of 2025 and into 2026.